Oh my, look at this face. This is definitely not my best picture, but it was kind of, I did that on purpose, mostly because TD and CIBC Q3 earnings has been pretty much same old, not really exciting, pretty much boring. We didn't learn much about the state of the economy. Nothing compared to what we have seen already, actually. It's just pretty much history repeating. Few days ago, I've done a video on ScotiaBank and BMO, and then I reviewed National Bank and Royal Bank earnings. And today, we're finishing this Big Six earnings review with TD and CIBC. So links are way down below in the description if you want to look at the others. Needless to say, TD and CIBC are not my favorite, mostly because they are more targeted to classic banking, savings, and loans. TD is doing well, CIBC not so much, so we'll look into that today. In a few words, as I said, same old, so nothing impressive. They did better than what was expecting, but you know what? Analysts expected like so little from Canadian banks that it's not a surprise that most of them have actually beat expectations. So what TD said, TD said pretty much like they kind of like recovered from several comments we had in the from past CEOs. So we're talking a position of strength, that they're prudent, they're well capitalized, strong liquidity. So basically, they're a strong bank. You should trust us. I have to say though, common equity tier 1 capital ratio at 12.5. This is the highest of all banks. Royal Bank impressed me at 12, and now we have 12.5 for TD, so that is quite impressive. I'm pretty sure that they're going to do well in the future. They experienced some good volume growth, and they were managing credit provision in a good way. Pretty much same comments that we had from Royal Bank and National Bank 2 days before. So it's pretty much in line, and obviously they focus on a diversified and resilient business model. So let's look at that. Net income earnings were down 30%. So not the end of the world because it was mostly created by huge credit provision for credit losses. You can see it's like $2 billion. It was 3.2 in April, but as comparison to last year, we're at 655 million. So big jump over here. Less like it was a little bit better than April, so which was expected. For this one, they have highlighted 7.4% of their portfolio to be highly at risk due to COVID-19. So not highly at risk, but having like a hard impact on those sectors, which is not the end of the world. They have include automotive parts into that, energy, retails, and so on. It's pretty similar to what we have seen to RBC with 7.1. So now we're at 7.4. Things are pretty much normal over here. Their U.S. exposure hurt. U.S. retail was down 64%, so that didn't help. Mostly higher provision for credit loss, obviously. At least the wholesale segment, which is roughly generated about $400 million in earnings this quarter, was up by 81%. So this is the good news inside of their business model. You can see on the right corner, segment and net income. So we have 53% from Canadian retail, 28% from US retail, and then wholesale banking at 18.6. So we wish it was a little bit bigger, so the results would have been better. But still, I mean, when you look at the CET ratio at 12.5, it was 12 last year. So then we have actually an improvement. It's pretty cool considering that we're during a recession. So same old, but so far, so good. TD Bank is doing well. You don't have to worry about the dividend. That's quite obvious. We have a payout ratio for this quarter at 70%, under 70%, sorry. So at 63, so which is very solid. So when you look at the other banks, besides in Scotiabank that is over 80%, all of them are showing 40, 50, 60% payout ratio. Don't have to worry about their dividend payment. It's going to go well. The only thing I'm wondering about TD right now is where the growth is coming. They are about to complete the sales of their stake in Ameritrade to Charles Schwab's. This should close during the upcoming 2 quarters. So this is a done deal. They have wealth management on their side, but will they be able to grow in the US right now? It's kind of like uncertain. We'll have to follow the virus to know more about that. So far, we're recovering very well in Canada. In the US, it's not so evident. And I'm not going to go into theories and so on because I have no knowledge of the virus and how it's spreading, but I'm not a specialist. But you know what? This could be a long year for TD just for that reason. But in the meantime, you can enjoy a strong dividend and you don't have to worry about anything. Now, in regards to CIBC, it was kind of like the most boring comment. So they're just saying that they have some solid financial results, which I believe they were okay, not solid. Disciplined expense management, they're resilient. So didn't learn anything new here. Pretty much repeating what the other CEO said. And that's, I'd say, that's maybe a problem when you're dealing with an oligopoly like we have in Canada for Canadian banks. Pretty much the entire market is controlled by the big five. I always include National Bank because it's my favorite bank, but more than that, because they're very strong in Quebec, but they don't make a significant difference outside of that province as opposed to the other big five. But basically, they're in the same situation. They do pretty much the same kind of business, and this is one of the reasons why I see so many investors having like 4, 5, 6 banks in their portfolio. You're pretty much just duplicating the same asset. So you just force yourself to follow more companies every quarter for absolutely no reason, because you know what? They're saying the same thing. They are pretty much doing about the same business, and you're better off selecting your best 2, your best 3, and then move on. But you know, that's just my opinion. So CIBC is healthy. We have outline of their credit provision for credit loss here. 525 million, up from 291 last year, but a lot lower than in April. So this means that they did a good assessment. I was not satisfied with that graph that I'm presenting, because they're not telling you exactly, you know, for commercial real estate, they have 11% of their portfolio in it, but they're not doing the ventilation telling you exactly which type of loans is at risk due to COVID-19 and which aren't. So we know that they have 1% in auto lending, 1% in leisure entertainment, and 2% in gas. So you can assume that pretty much align with the other banks. 5, 6, 7% of the portfolio is a little bit more at risk. The rest should be doing not too bad. So we have earnings and EPS down 12 and 13%. Not the end of the world either there. Was kind of expected at the same time. So nothing to worry here. What I want to highlight here is the classic banking model doesn't pay off too much right now, and I don't expect it to pay off very well next year in 2021. In this case for CIBC, you see that Canadian personal business is down 23%, Canadian commercial and wealth management minus 7%, and then U.S. commercial and wealth management is down 58%. Thank God they have a good portion of capital markets at 67%, that was up 67%. So that kind of like helped to balance everything out. And they still showed a very strong common equity tier capital ratio, 11.8, slightly up from April, pretty much in line with what we have seen so far. So not the best in class, but not the worst either. So very solid bank, very generous yield, obviously. The yield is safe. Don't have to worry about that. We have a payout ratio of 54%. So if you're income seeking investor, CIBC could fit very well in your portfolio, which is kind of cool. At the same time, you're kind of limited about that. So you can look now at CIBC such as a deluxe bond. So meaning that they're going to pay a very high yield, so very stable yield. So that's great. But don't expect too much in terms of stock appreciation, which could be good depending on how you build your portfolio. It's not the end of the world, but as you can tell, CIBC is not my favorite bank. Next week, I'll prepare a wrap-up including the big six. I'll probably take a look at Laurentian Bank and Canadian Western Bank just to make sure that I've covered the entire sector in Canada. To be honest, I dislike both. They were rated as sell a long time ago at DSR, way before the pandemic, so I'm not surprised that they're not doing so well. Laurentian Bank cut their dividend last quarter. I don't expect anything from them. And Canadian Western Bank, I haven't looked at their report yet, but you know what? They're tied with the Alberta economy. The government of Alberta is expecting like a 24 billion shortfall deficit this year for their budget. The economy is definitely not rolling right now. So unless you believe that the oil sand is coming back anytime soon, you're gonna have to take your pill and wait for a long time for this one. So I hope that you have enjoyed this video. Make sure that you like and follow my channel. Next week, I'm coming back with a full wrap up. I'm going to give you my rating, so I'm going to tell you which Canadian bank is my favorite and for what reason, and we're going to go from position number 6 up to position number 1 in a simple video. So until my next video, stay invested.